Hello everyone, my name is Manolis Spinorilakis, the founder and producer of Reality Crowd TV, and welcome to a very special episode of Reality Crowd TV, Equity Crowdfunding, the State of the Union, with the founder of StartEngine.com, Ron Miller. We have an amazing show today, but before I introduce our wonderful guests, I'd like to just tell the audience a few ground rules. Today we will be heavily involved in our Q&A application. We have it up right now, so for anyone watching in the audience, if you have followed the Circle of Reality Crowd TV on Google+, you'll be able to submit any kind of questions for myself or Ron during the broadcast, and at the appropriate time we will address any and all questions. Toward the end of the episode, we will turn on the Showcase application, where you will see the links to the Securities and Exchange Commission website. You will see the links to StartEngine.com, and as well as a contact form for Reality Crowd TV, in case you would like to be featured on one of our episodes in the near future. So today's episode is going to be really great. There's a lot of things that many of our viewers know about crowdfunding, specifically the donation in exchange for reward-based model, but many people may not know about the new equity crowdfunding model that has been around since 2012. So today's guest is going to really be our expert, and he's going to tell us really the state of affairs in equity crowdfunding, specifically focused on Title III equity crowdfunding. And we will get into a brief history of what that is in a moment as well. So without further ado, I'd love to introduce our guest, Ron Miller, the founder and CEO of StartEngine.com. And Ron, thank you for joining us, and please introduce yourself.
Thank you, Manolis. I appreciate it, and it's a great honor to be here on your show today, and certainly an honor to talk about equity or investment-based crowdfunding, because I think it's one of the greatest advancements for entrepreneurship in a generation. And it's a real exciting thing to be personally a part of it. And I want to thank you for doing what you're doing to help create and promote this industry, because it's going to offer huge opportunities for innovators and entrepreneurs to bring to life their ideas. So thank you.
Pleasure. And so, I mean, you're absolutely right. I mean, this movement has been sweeping the nation now since 2009. But can you tell us a little bit about StartEngine.com? How is your company involved in the crowdfunding industry? Maybe tell us a little bit more about your specific background that allows you to leverage the skills that you learned in your other endeavors, and how you transitioned into this crowdfunding industry.
Sure. So by way of background, I am a startup entrepreneur. It's all I've done my entire career, and I've started and exited successfully from 4 major companies through my career, including one company that went onto the NASDAQ pink sheets. One was a corporate sale, another was a merger, and another was a employee buyout. So I've done it in all kinds of ways. And as a startup guy, and all I've done is started and run companies through my career. I've also been nominated to the Ernst & Young Entrepreneur of the Year Award. I've been a successful 4-time Inc. 500 winner as well. And so all those things gave me some background as an entrepreneur to really understand what it takes for a company to start up and succeed and scale. Last fall, I joined my partner, Howard Marks. Howard was the co-founder of Activision. It's now one of the largest game companies in the world. And he had a successful exit there, and also has built some other companies. So he is also a career entrepreneur, although he comes at it from more of a software engineering background. And the two of us joined forces to essentially disrupt our own model in StartEngine. StartEngine was the largest technology accelerator in Los Angeles. We've invested in 57 startup companies since in the last 2.5 years. And we took a look at our model and we said, you know, there's a better way to approach this. And instead of using our judgment about a team and a concept, we're instead going to have that team and concept initially do an investment crowdfunding campaign. And among those that are successful, we will match the capital raised and then invite them into our accelerator. And if they're interested, we'll connect them with our mentors. We'll help them with their go-to-market strategy. We'll help them refine their pitch, and finally we'll introduce them to angel investors and venture capital companies that will help further fund these companies to success.
Excellent. So, I mean, that is amazing. Your experience is incredible. Your co-founder, Mr. Marks, as you mentioned, is co-founded Activision, which is now a $14 billion company. So the expertise that you and your partner bring to bear to StartEngine.com is amazing. So once again, we're extremely grateful, Ron, for having you on, and so you're obviously very anxious for the new equity crowdfunding laws to get finalized. But for the audience, I think there'd be a good level set here to just bring everybody down to square one to explain, how did equity crowdfunding come to be? And so with the Kickstarter model, Kickstarter.com is a rewards-based crowdfunding site, and that really started back in 2009. Global crowdfunding at the end of 2009 raised about $1 billion a year in capital annually that year. At the end of 2013, that growth of capital raising through crowdfunding accelerated to $5.1 billion in 1 year. I was in New York 3 months ago, at a real estate and alternative investment finance crowdfunding event, and they estimate that at the end of this year, 2014, it's going to be $7.1 billion globally. And so back in 2012, when the government saw how amazingly and how quickly capital was being raised through this rewards-based model, they immediately asked themselves the question, if it works for a donation in exchange for a reward, which essentially you're not buying a piece of the company, you're not buying equity in a company, they said if it's working so well in that model, would it work with an equity-based model where, in fact, a contribution would purchase a share in a private company, or you can loan that company debt in the form of a bond, and your hypothetical reward, or actually your tangible reward, would be the dividend on that share or the interest on that debt. So that's exactly what they did in 2012. And Rana, I believe you also had a few statistics too that you could share with us as to how quickly the crowdfunding industry is growing.
Yeah, so if you consider, Manolis, just Kickstarter alone in the last year, in 2013, there was over $500 million in capital raised for projects on their portal, just in that one portal. There were over 19,000 projects that were successfully funded by over 3.2 million investors. So looking at the scale of that, it leads one to a very easy conclusion to say that if people were allowed to get equity or become owners of these companies, that it would multiply that several times over. So I think that's in part what the potential of investment-based crowdfunding is, and why it is that Congress saw this and said this is the right way to allow innovation and entrepreneurship to grow here in America, and allow it on the basis of investment crowdfunding. I suppose you should mention that, for the past 80 years, the Securities and Exchange Commission has essentially precluded the ordinary citizen from investing in private companies through regulations. The assumption was that people of ordinary means weren't necessarily sophisticated enough to make the kinds of investment decisions that are incumbent with small private businesses. In addition, the SEC has prohibited companies from advertising their offerings. And that's really what the Jobs Act did. It really sort of opened that up so that the average everyday person could invest in private companies and participate in the explosive returns that are generated by many of the tech companies and other companies that we've seen over the past 5 years.
You're absolutely right, and that's why there's so much excitement, because as you mentioned, since 1933, you had to be what is known as an accredited investor in order to invest in these private companies. And for the audience, an accredited investor is an individual who makes $200,000 a year or is worth $1 million in net worth, excluding their personal residence. That limit goes up if you have a partner. But in general, it was essentially only the wealthiest of Americans could invest in a lucrative private company offering, and that back then the thinking was, the Great Depression just happened. We want to protect the ordinary Americans from, losing their shirt, so to speak.
Correct.
But as you mentioned, 80 years later, we have the internet at our fingertips. We're a much more educated population. We just have a wealth of information that we have access to. And finally, that arcane law was reevaluated, and they said, let's give it a shot. And we'll go into the details exactly what that'll be in a moment. but I also wanted to share with the audience a great video that the White House released just after the law, the 2012 Jobs Act, was signed. And if you've watched our show previously, I do tend to show this video a lot because the young lady in the first 12 seconds in particular explains what crowdfunding is in such a great way that I would recommend memorizing the first 12 seconds if anyone ever asks you what crowdfunding is. So here we go. We'll pull that video up right now, and we will play it right now.
Crowdfunding is a concept that's been around for a long time. It's the idea of passing around the basket at church in its oldest incarnation, of the large crowd of people being able to contribute small amounts, which in aggregate meet the financial goal of any organization, group, or individual. And so when you look at crowdfunding and how it's evolved, the reason it's become a buzzword recently is because it's gone online, and so the potential of it has expanded exponentially. The crowdfunding bill is important for small businesses because it creates access to capital. Access to capital that currently is very hard to come by. The basic concept of what this will mean for entrepreneurs and investors is that an entrepreneur will post a description, a very thorough description of their business, the finances, the business plan, what they're going to do with the money, the budget, etc., and they're going to be able to share this opportunity with anyone they so choose. Most likely it'll be their customers, friends and family, might be Twitter followers, people who share an affiliation with them they think might be interested, etc. The investor will then pledge a certain amount of capital that they want to invest. If the fundraising goal is met for how much money that entrepreneur is looking for, then the money will transfer to the entrepreneur. So it's an all or nothing arrangement. What I hope that America will now see is that after the SEC rulemaking period is done on the crowdfunding bill, approximately 9 months from now, and platforms can be created and launched that allow for crowdfunding, that entrepreneurs who currently feel like funding is a roadblock to them achieving their success can now have the opportunity to succeed. I strongly believe that crowdfunding is not just for high-tech businesses. I, in fact, think that the majority of people are going to be using this in the long run. The majority of businesses in the country are small businesses, and that's who can really take advantage of this.
So as you can see, it's really an exciting time. It's an amazing opportunity for entrepreneurs and startup companies in the United States to really reinvigorate the American dream. I honestly believe that crowdfunding is contributing to reinvigorating that American dream, to believe that with effort and with the access to capital and with mentorship and guidance from a much more collaborative startup ecosystem that I believe is being formulated right in front of our eyes with companies like yours, it's becoming an amazing transformation that we're seeing, and it's really exciting. One thing that she mentioned is the SEC. So the SEC is the organization that is regulating the 2012 Jobs Act, and they're tasked with the implementation of it from specific rules perspective. And so, Ron, for the audience, can you give us a brief overview of the provisions that relate to crowdfunding that were in the the 2012 Jobs Act? And we'll specifically talk about Title III, but is there any other provisions? Title II, I know, is one of them, and then of course Title IV. But is there any other provisions that is in use right this second where startup companies and investors are able to invest currently as a result of the Equity Crowdfunding Law, the 2012 Jobs Act?
Yes, currently there's really kind of three different components of the Jobs Act which really relate to crowdfunding as we've been talking about it today, Manolis. First is Title II, which is the portion of the Jobs Act that allows companies to raise capital from accredited investors. So that is a crowdfunding, investment-based crowdfunding rule or law which enables companies to raise capital, but it is limited to accredited investors only. And Title II is actually up, working, and in fact achieving some incredible success. And I suspect, Manolis, that it'll make up a huge portion of that 5.1 to 7.2 billion growth that you mentioned earlier. So that's Title II. Title III is the one that's really much more like Kickstarter because it is targeted and designed for unaccredited investors. This is your average everyday person. And even though the law has passed and the draft rules have been promulgated and comments have been submitted and considered by the staff of the SEC, it has not yet been finalized. We expect that to happen imminently, meaning sometime I would suspect in the next 30 to 60 days we're likely to see a vote where the chair of the SEC puts it on the agenda and the commissioners would vote to approve the final rules. And that would happen, we're hoping, within the next 30 to 60 days.
Very interesting. And so, being part of this since October 2013, and you know the date, October 23rd, 2013 was when I actually started this company, because I was sitting in my cubicle at the Hartford Insurance Company. I was an internal auditor at the time. Out pops the press release, a 584-page document, and I didn't do much work that day because I read all 585 pages while I was at work. But it was the Title III proposed rules that the Securities and Exchange Commission had actually proposed. And so this was back in 2013 in October. It's almost 1 year since the proposed rules was out. And the way legislation and regulation works, and I didn't know this until I was following what was happening. They allow the general public, when they propose a rule, that they allow the general public to actually submit their comments. They asked over 200 questions to the American public, and the American public had until February 3rd to submit the answers to those questions that the government asked of them. February 3rd rolls around, comments were submitted, and now, to this day, the final rules are still not set yet. So after February 3rd, it's now October, nothing has been done. And so that is why, Ron, you, and I've witnessed it myself, your leadership has sprouted a grassroots effort, along with many other people in the industry too. It's a team effort. There were a lot of people, but you were a very big spark and a kick in the pants to all the people in the industry to begin, causing a little bit of a grassroots uproar about this. And so, can you tell us, since you started your campaigning to release the rules for Title III, how many comment letters urging the Securities and Exchange Commission has been submitted since you began your grassroots effort to put some pressure for them to release the rules?
Manolis, we started the Grassroots initiative about 6 or 7 weeks ago. And in that period, there's been currently 142 letters that have been submitted by primarily issuers. There are some folks that are, portal developers like myself or other stakeholders, and also some investors. But the predominant comments came from issuers. These were entrepreneurs who basically said, look, if the SEC finalizes the rules, and of course those comments are considered appropriately that were submitted into the comment period, then we're ready to go. And we will use Title III to raise capital, to hire people, and to bring forward into the market the innovations, technology, and entrepreneurial businesses that we want to start or grow using the capital created through Title III. So that's the majority of those comments, and kind of the philosophy behind it, Manolis, was really pretty simple, is that even though the SEC is an independent administrative body, it is not really a political organization, and so therefore is not kind of subject to the same kind of lobbying that might be more, fitting for a congressional effort. Here, what's important is that the SEC and those stakeholders and those politicians that got behind this thing to begin with understand that there's a whole community out here, and not just a few of us, but literally hundreds and thousands and likely tens of thousands of entrepreneurs who, like you mentioned, but for that restricted access to capital, would be able to start companies, hire people, and bring forth technology into the market that otherwise won't be created. And so the idea is to let them know that there's a lot of folks out here that are depending on the SEC and that are holding a stake in getting those final rules out.
Absolutely, you're right. I mean, this is, access to capital is extremely needed. Since the greatest recession, since the Great Depression, I mean, it's been very hard for small businesses to get the capital they need to, either start up or to even sustain their operations. It's just been a very tough struggle for small businesses in the U.S. since the credit crunch, and so you mentioned something amazing. So 6 weeks, 142 letters. Number one, amazing. Thank you for that. And number two, you mentioned they're an independent agency versus having a lot of political pressure. But as you mentioned, there is some political pressure, and it comes from interesting sources. The media, of course, is a very large political tool that people use to put pressure on organizations that should remain independent. And maybe you could tell us why this effort is needed. What has been the sentiment in the media about Title III, and are there any misconceptions that the media is putting out there, or are there any initial comments that maybe that you believe or others believe perhaps overestimated some of the issues? So give us your thoughts as to why this campaign was needed, specifically talking about the media element and how they often exert a lot of political pressure on organizations like the Securities and Exchange Commission.
Sure. Well, the whole idea of allowing individual investors to invest in private companies that are founded by entrepreneurs is kind of novel and new and a pretty radical change for the SEC. And because of that, it took them quite a while to come up with the 600 pages of proposed rules. Now, my belief, in contrast to what I think might have been covered in the media or stated publicly in other places, is that the staff of the SEC did a great job. I mean, they did a phenomenal job at taking that first step at creating those 600 pages. That was no easy feat, number one. And number two, I believe it reflects a serious commitment by the chair, by the commissioners, and by the staff to come up with an appropriate balance between efficient formation of capital and protection of investors. Now, that said, when you get into something this complex, there's always problems, challenges, and let's say things that are less than desirable. And so what happened is, I think there were a lot of folks in the industry that sort of picked up on those things, and while they did very constructively submit comments to the SEC pointing out those changes, and I believe that many of those changes are appropriate. I believe that many of those changes have been considered by the staff, and we will see those changes in the final rules. Yet, during the time, I think in the late summer, when I got involved in this, I saw this kind of lull in attention, the lull in the pressure, and the lull in the activity. So what it left is the media only to point out the criticisms of Title III, which I think were appropriate and well taken, and I think can and should be considered by the SEC. However, it's also important to tell them, guys, we've waited long enough, and we understand that with the Dodd-Frank rules and other changes that were forced upon the SEC and rules they had and other work they had to do, that's understandable that it got late, but now's the time. And now is the time to release the rules and to make the catalyze the industry essentially through the legalization of this process of raising capital for the companies that probably many of your listeners want to start and are ready, willing, and able to go.
Absolutely. You are 100% correct. And one of the biggest criticisms that I believe has been stated, and a lot of the comment letters early on point out to the cost to issuers. And so an issuer is just a fancy way of saying a small business. So if you're gonna raise capital through crowdfunding using equity through the 2012 Jobs Act, you are now known as, if you're a small business, you're now known as an issuer because you're regulated by the Securities and Exchange Commission. So one of the biggest criticisms is the costs for an issuer to comply with the 585 pages of regulation. And again, those are the proposed rules. It's not going to be the final rules per se. Some of the things in the proposals will remain the same. As you mentioned, they will consider a lot of the comments, and hopefully they'll make the right decision. But some of the pressure that was being applied grossly overestimated the cost to issuers. And so would you like to speak about that issue in particular? What have you found out through your own research that makes you believe, and I actually agree with you, but in your own research, what have you found that the early criticisms potentially may not be valid?
Well, I find that the original costs that were estimated, for example, I guess we should review that if you want to raise more than $100,000, Manolis, any entrepreneur is going to have a CPA review their historical financials. In addition, if you're going to raise more than $500,000, you're going to have a CPA do what they call an audit. And these are just a process where a CPA goes through, digs in, and makes sure that there's accuracy in the historical reporting of financial results. Now, what they did was, and it wasn't unreasonable at the time, they just sort of went out to some firms that provide audits and reviews. And typically, most companies, it's rare you see a company do an audit if they're under 20 million in revenue. I would just use that as sort of my general marker. And usually it's companies that are 100 million and over do reviews and audits. And that's for purposes of primarily financing, getting loans from banks, or in some cases in the public markets, they're required to be audited and that kind of thing. But in using those numbers, they went out to some regional and national accounting firms and got quotes about what it would take to do that. And those were really kind of based on what historically was done, audits and reviews for larger companies. Here, when you talk about Title III, we're talking about smaller companies. And smaller companies can use smaller firms, number one, and number two, don't have the kinds of lengthy operating history or complexity that you might see in the bigger companies. Excuse me. So as a result, we've seen costs that are much lower than what was originally quoted. I mean, there's some companies that are in the range of anywhere from $2,000 to $9,000 for review, and anywhere from maybe $3,000 to $9,000 for an audit. Those are general ranges that were quoted to me by a couple of different companies that are in the field. And importantly, there's a number of entrepreneurs that are coming forward to automate and really use a more efficient approach, a more technology-based approach towards how they perform this kind of work. And because of that, it's going to deliver efficiencies which will then result in lower costs into the marketplace. And I think as we go forward, as soon as Title III is released, we'll see more of those entrepreneurs emerge. But certainly as you wait 12 or even 24 months after they finalize the rules, I think we're going to see many entrepreneurs come forward with new approaches and efficient businesses to create higher quality, lower cost reviews and audits than what we've seen traditionally and historically by regional and national CPA firms.
Absolutely, and I used to work for Deloitte & Touche as a financial auditor myself, so one of the largest accounting firms in the world. And when I was looking at some of the comment letters, they said that, you know, for a company that's trying to raise over $500,000, and for the audience, under Title III, under this crowdfunding law, which allows you to raise money from anyone, regardless of income, a startup can raise up to $1 million a year, and investors, meaning the general public, can invest based on certain income thresholds. So if you're an investor and you want to invest in, let's say, your brother's startup company, if you make $100,000 a year or less, you can only invest $2,000 or up to 5% of your income for a max of $5,000 per year. If you make over $100,000 a year, you can invest up to 10% of your income for an annual cap of $100,000 a year. So there are safeguards to protect investors, because the fact of the matter is startup companies are risky. I mean, the statistics don't lie, you know, except Ron and I just choose not to be part of those statistics, but, you know, the statistics show that 95% of startups fail. So it is going to be a rather risky asset, but it's great that the Securities and Exchange Commission has safeguards so that people can't just dump their life savings in 1 year into these investments. But I wanted to give the audience a little bit of a background on that, but the point I was trying to make is these comment letters said an audit would cost $20,000. As you just mentioned, you did research and you got quotes from smaller accounting firms which are still very prestigious and accredited, and they follow the state accounting laws. In Connecticut, it's the I think it's the CSPA or CTSPA. I should know this by heart, but I don't. But you know, these smaller firms are charging between $2,000 and $9,000, and the comment letters are quoting $20,000. And there's a reason for that, because of course you want to show and put pressure on the SEC to say you don't want them to have the audit requirement at all. That's the point of overestimating. But I believe it's having a negative effect on the process. I'd rather it be fully transparent and accurate than overestimating, because maybe then Title III may not even come out at all. And that would be the worst thing that would ever happen, is scaring everybody into thinking this would not be a valuable asset to small businesses, when really it would be the greatest boon to small businesses that the world has seen since 1933, since you know the act prohibited this from even happening. So I'm glad you mentioned that. And you said certain companies are using technology to automate certain functions. Do you have examples of these companies? Do you know any examples of how technology is being used to reduce compliance costs?
Sure. I think there's a couple of great examples. One is a company called CrowdCheck, which has systemized and automated. This is led by a former SEC attorney, and there have been a systemized and automated approach towards compliance for crowdfunding, making sure that the entrepreneur meets all of the requirements that are set forth under the rules. So that's one example. Another example is a firm called Crowdfund CPA that has developed some automated techniques for performing reviews and audits to substantially reduce those costs as well. So I think those are a couple of examples. There's another company called Fund Hub, and also led by a former securities attorney and some folks actually that are, I think, on the board of FINRA or something like that. And they have also developed a highly efficient process to help ensure compliance, so that when an entrepreneur needs to raise some capital, they can make sure that just by going to one of these guys, that for a few $1,000s, they'll make sure that all the I's are dotted, T's are crossed, and the process is done completely compliantly, and of course without the need of having to hire an attorney to do research for that specific project.
Absolutely, and I'm sure, you know, I'm sure even the funding platforms for equity and debt will have a certain amount of automation built inside of their mechanisms too, because I know the regulation requires certain funding portals and certain, you know, broker dealers to have a certain level of due diligence done on these companies before they bring it to the public too. So there's a lot of safeguards. There's a lot of costs that will be spread among the whole ecosystem to make it more affordable for issuers and for startups to raise money this way. And to give people to kind of drive the point home as to why Title III is so revolutionary. An accredited investor, as I mentioned earlier, is someone who makes $200,000 a year or is worth $1 million in net worth. In America, there's only about 8.7 million people who qualify based on that wealth threshold. Title III is saying that now you don't need to have that level of wealth to invest in a private company, and that was not possible for 80+ years for someone who is not that wealthy to invest in a private company. Once Title III equity crowdfunding is finalized, you now go from 8.7 million Americans who could only invest in a private company to over 300 million Americans who would now qualify under the new rules. That in itself is a huge expansion of capital, and it just like the Kickstarter model, it's people funding people. This isn't, you know, a startup going to a bank and a bank saying no, or a startup going to a venture capitalist and a venture capitalist saying no. This is a person who can actually have a third option, just like the Kickstarter model, but this time the backers of their startup company are actually buying a piece of the company, or they're loaning them debt. And this will be able to expand access to capital. It'll create thousands of jobs, even millions of jobs over the years. I mean, this is the most exciting thing to happen in capital formation in decades, literally, in generations. And so the work that you're doing, Ron, cannot be understated. And if the audience wanted to help to continue pushing, you know, the mission forward to get the rules released as quick as possible, what could they do to help in this effort?
So what they can do is submit a very short formal comment letter to the SEC. It's really simple. It's just an issue of sending an email. And the email address is rule-comments@sec.gov. That's rule, R-U-L-E, -comments, C-O-M-M-E-N-T-S, @sec.gov. And then you just put a reference in the subject line that says file number S like Sam 7-09-13. That's file number S like Sam file number S like Sam 7-09-13. And all they have to do is simply reference the Title III rules, indicate that they're an entrepreneur that's interested in crowdfunding under Title III, and urge the commissioner that now that the feedback and comments have been considered, now is the time to finalize Title III. And once she does so, that we will move forward to create companies, hire people, and spur innovation right now as soon as those rules go live. That's basically it. And putting it in your own words is very important. We've been told that form letters really are not helpful. And to indicate a little bit about your company, who you are, what your company is, what your technology is, all that's really helpful, but not necessarily required. But most importantly, just send a brief email to Chair White and indicate that you believe the hard work is done, and now is the time to get it through the finalization process.
Wonderful. And what we'll do is I actually wrote down the actual email address in the subject title line. At the end of our show, I'll put it into the event description so that people know exactly what you just mentioned, because I know it's going to be hard for people to write that down. So, hopefully by the end of this show, we'll have another 10 comment letters at least submitted. I hope so. I hope the audience feels inspired, because it really is something that, if you're an entrepreneur, you need this to raise capital. If you're an investor, you will have more options to invest in. And if you're just someone who can't find a job right now, if there's more businesses being created and you need more work, then you want more businesses to be started. And then naturally they have to hire more employees. So, this is really a critical time in the United States history as far as capital formation is concerned, and it's an exciting time to be alive, frankly. So I really appreciate your time today, Ron, and I always like to ask a final question, but before we do, there is one question and comment from my friend Marlon Adams. Marlon Adams is the founder and CEO of culturalgrassroots.com, a rewards-based crowdfunding platform. And he actually has a comment and question. It says, can you talk about private placements and how banks and investment houses actually execute these non-public offerings, and whether portals like Kickstarter and their communities can utilize similar techniques? So maybe with your past experience, Ron, can you tell us the old way of how private placements used to be done? I believe the rule was Rule 506B, and now explain how crowdfunding for equity and debt is now revolutionizing that old process?
Sure. Well, basically, under the old rules, it was under 506 limited to accredited investors. So that goes back to limiting the pool of potential investors to that 8 or so million folks out of the 300 million in the population. So that is one huge change. In terms of the process itself, there was a self-certification process that an investor would have to do to show that, or to indicate that they were an accredited investor. And there was some paperwork, disclosures, and so forth that had to be followed by the issuer. But it was all done with, I guess, paperwork intensive, and it was not done online. And you certainly, under no circumstance, could you advertise publicly for a Reg D offering. So those were kind of the basic sort of major changes. And I think to address the question a little bit more specifically, I think that once Title III begins action, and there are securities that are issued, stock owned by people that invest, I think the next step is that the marketplace is going to develop a secondary market that likely, I believe, is going to be specific to the equities which are being issued under these various crowdfunding rules. There's, I think, a company called Second Chair out of New York. There's a few others that have also popped up, but again, this is entrepreneurial opportunity for those that have familiarity with the buying and selling of securities in the secondary markets to create vehicles and portals by which sellers will be able to get together with buyers, and people will be able to achieve liquidity of these shares.
Absolutely. So you raise a good point, because now with equity and debt-based crowdfunding, you could think of it, I mean, eventually it'll become this sophisticated where someone will have sort of like an Ameritrade brokerage account where they're purchasing crowdfunded securities, and then, as you mentioned, there will be a stock market or a bond market for these securities to trade and exchange hands more freely. So you're right. There's a lot of opportunities here for entrepreneurs to come in and provide those type of solutions to the 585 pages. And so, what is the purpose of a company? To solve problems. Is there a lot of problems in the regulation? Sure. But it's the job of startups and entrepreneurs to come up with innovative solutions to that, and they will and they are, and that's why it's exciting, because technology is taking what used to be a big problem and making it simple. So it's really exciting to see all this happening. And Marlon, thank you very much for that question. Truly appreciate it. So finally, Ron, I know we're running short on time. The last question I'd like to ask you is more so, I'd like you to be a fortune teller and tell us, 5 to 10 years in the future, how do you see entrepreneurship in America, and where do you see the crowdfunding movement going 5 to 10 years from now?
Well, I think it's a great question, Manolis, and in part there's a pretty fundamental demographic shift taking place where the millennials will soon be the driving force of the economy. And those are the folks that today are driving crowdfunding as we know it through the gift and donation portals. And I think that as they mature and continue to become a greater economic force, that crowdfunding will become just sort of standard operating procedure. And the reason I say that is that there's more of a desire for people in that generation to be connected to the companies that they do business with. In other words, they seek and aspire to that connection. Second is, in terms of marketing, companies are going to soon recognize a major shift in advertising and marketing, which is going to essentially declare traditional media dead. Television, radio, print, and so forth. And even this kind of advertising that we see today on the internet, the pay-per-click and that banner ads, I think that's going to be pretty tired and not very effective on a return on investment perspective. So companies are going to need to be able to engage the social networks of their customers and prospective customers, and there's no better way to do that than having thousands of owners, partners, shareholders who are engaged with that brand and that company, promote that brand and that company to their friends and their social media networks. And that's what I think the world looks like 5 years from now. I also think that we probably may not even use the word crowdfund. It might just be called startup finance, because that's just the way that it's done. So I think that even our nomenclature may change as well. But I think it's very exciting, and I think that what's important is it is furthering the movement of power from producers to consumers to be able to control the products and services that they receive and pay for in a meaningful way. And I think that's going to be probably where the greatest revolution is.
Well said, Ron. I agree with you. I think crowdfunding, that word is going to change dramatically, as you mentioned. It won't be called crowdfunding in the future because it's just going to be the way it works in finance. And so thank you very much for your time today. We had a great turnout for the show, and I'm really excited for the future of America. I'm excited for your business, StartEngine.com. I hope the rules get released so that you can begin to help not only the 25 companies a year you help now, but just like that. I mean, you want to help a lot more. You could help hundreds, even thousands, if these rules get finalized. So, Ron, thank you again for joining us. I'll give you the last word in case you want to say one last word. Where could people contact you? Things of that nature, and then we'll wrap up the show. So, any last words, Ron?
Absolutely. So if you want to stay abreast at when the final rules are released, one thing you could do is follow us on Twitter, which we're using for the campaign to get letters into the SEC. It's Vote on CF. And you can use that to follow the Title III movement. You can reach me personally if you'd like. My email address is ron@startengine.com. That's ron@startengine.com. And I'm happy to help anybody with questions or support or whatever they need, because after all, the mission of StartEngine is to help entrepreneurs achieve the American dream. And that's what I'm looking to do. That's a big part of what drives me when I get up in the morning, and I'm happy to help you, Manolis, and I'm happy to help all of your listeners with what they need to help achieve their dreams.
Thank you so much, Ron. Again, it's been an absolute honor. You've informed me. You informed our audience. We all know what we have to do. We have to contact the SEC. We have to urge them to release the rules. and all that information will be put on our event page for all the viewers and all the invitees to actually take action afterwards. So once again, Ron, thank you so much. Enjoy the warm weather in Los Angeles.
Thank
you. And everyone, audience, thank you for joining us. Without you, we could not be putting on these shows. And until next time, dream it, believe it, achieve it. Have a good night now.